Okay, so you want to own a resort. Picture it for a second. Turquoise water, private cabanas, a bartender who knows your drink by day two, a beach that somehow never has anyone else on it in the photos. That's the dream. That's what people picture when they imagine owning a resort. Here's what actually happens. Some resorts generate over $300 million a year in revenue and throw off cash like a machine. And some resorts, the ones with the exact same infinity pool, the exact same overwater villas, the exact same five-star rating, lose tens of millions of dollars a year, every year for a decade straight. Same category of property. Completely different financial reality. Today we're going inside the real economics of one of the strangest businesses in the world, a business that sells paradise and often can't turn a profit doing it. Before we talk about money, you need to understand what makes a resort fundamentally different from a hotel, even though people use the words interchangeably. A hotel in a city has one core advantage. It can fill rooms 365 days a year because business travelers, tourists, and locals all draw from the same pool of demand at different times. A resort does not have that luxury. A resort is almost entirely dependent on leisure travel, and leisure travel is seasonal, discretionary, and brutally sensitive to weather, currency exchange rates, and the broader economy. According to data tracked by hospitality analytics firms like STR, the average resort in a strong leisure market swings between 85% occupancy in peak season and under 30% in the off-season. A city hotel might see occupancy dip from 80% to 65%. A resort can see it collapse by 50 percentage points depending on the month. That swing is the single most important fact in this entire business, and almost everything else follows from it. Let's start with what it costs to build one. Unlike a city hotel, where the largest cost driver is usually the tower itself, a resort spends enormous money on things that generate zero direct room revenue: the land, the grounds, and the amenities that create the fantasy. According to HVS's hospitality development cost benchmarks, a luxury beach or island resort in a desirable location runs anywhere from $800,000 to well over $1.5 million per key to develop. And that number climbs sharply for remote destinations where every pound of steel, glass, and imported furniture has to be shipped or flown in. A resort in the Maldives, for instance, often has no local construction industry to draw on at all. Materials arrive by barge. Labor is flown in and housed on-site for months. A single overwater villa, roughly 900 to 1,200 square feet sitting on pilings above a lagoon, can cost $1.50 to $3 million to build before it has ever been slept in. Then there's the land itself, and this is where resorts diverge sharply from city hotels. A beachfront or waterfront parcel large enough for a proper resort, with room to build a golf course, multiple pools, a spa village, and enough distance between buildings to preserve the sense of privacy guests are paying for, can consume 15 to 25% of total project cost, even in places where land is nominally cheap, because so much of it sits unused as landscaping, buffer zones, and view corridors. A city hotel developer builds up. A resort developer has to spread out, and every acre of beautifully manicured lawn between the lobby and the villas is an acre that generates no revenue, but still needs to be irrigated, mowed, and maintained forever. Infrastructure is the next shock for first-time resort investors. In a city, you tap into existing water, sewer, and power grids. In a resort location, especially an island or a remote coastal site, you frequently have to build that infrastructure from scratch. Your own desalination plant, your own power generation, your own waste treatment. A mid-sized island resort can spend $20 to $40 million just on utilities infrastructure before construction on a single guest building even begins. That cost never shows up in the glossy renderings, and it never fully goes away, because now you're not just paying a utility bill, you're operating a small utility company as a side business to your hotel. Now let's talk about who actually owns these things, because the ownership structure of resorts is even more layered than city hotels. Major resort brands, Four Seasons, One and Only, Aman, Six Senses, almost never own the real estate. They operate under long-term management agreements, typically 20 to 30 years, signed with the actual owner, and resort owners tend to be a different breed than city hotel owners. Sovereign wealth funds buy resort real estate as trophy assets and geopolitical soft power. Ultra-high net worth families buy a single flagship resort the way someone else buys a yacht. expecting it to lose money and treating that loss as the cost of owning something extraordinary. Government tourism boards and destinations like the Maldives, the Seychelles, and parts of the Caribbean specifically court resort development because a single resort can create hundreds of local jobs and put a country on the international map, even if the resort itself never turns a meaningful annual profit for its investors. The management fee structure mirrors hotels, but with a resort-specific twist. Brands typically take a base fee of 2 to 3% of gross revenue, a further royalty of around 3% for the use of the name, and then, critically, resorts pay much higher marketing and distribution costs than city hotels because resort guests don't wander in off the street. Every single guest has to be actively pursued through international sales offices, travel advisor networks, destination wedding planners, and honeymoon registries. Distribution and marketing costs at a luxury resort often run 6 to 10% of revenue, nearly double what a comparable city hotel spends because the entire customer base has to be flown in from somewhere else, sometimes from the other side of the planet. Now, payroll. This is where resorts become genuinely strange as a business. A city hotel with 80% of its rooms empty can meaningfully cut labor costs. Day shifts get thinner, one restaurant closes, room service gets consolidated. A remote island resort cannot do that in anything close to the same way because the staff doesn't commute in from the surrounding neighborhood. They live on-site, and staff housing the resort itself has to build and maintain, often hundreds of employees deep, including their own catering staff, their own laundry crew for staff uniforms, sometimes their own on-site clinic, and even a small school for staff families in the most remote locations. Staff-to-guest ratios at ultra-luxury resorts commonly run between 3 and 5 staff members per villa, higher than almost anything in the city hotel world, because a resort is selling total immersion. A private butler, a dedicated dive instructor, a personal chef on call, a spa therapist who remembers exactly how you like the pressure. None of that staff goes home at the end of slow week. They're housed, fed, and paid whether the resort is at 90% occupancy or 20%. This is the core tension of the entire industry. Resorts have some of the highest fixed costs in hospitality attached to some of the most volatile revenue in hospitality. When a hurricane forms in the Atlantic, when a currency crashes in a source market, when a destination gets flagged in a travel advisory, demand doesn't dip, it evaporates, sometimes for an entire season, while the payroll, the desalination plant, the loan payments, and a landscaping crew keep running exactly as before. Let's talk about how resorts actually make their money back, because room revenue alone rarely gets there. A well-run resort treats the room as almost a loss leader for everything built around it. Food and beverage at a resort typically contributes a far larger share of total revenue than at a city hotel, often 35 to 45%, because guests are essentially captive. There's nowhere else to eat dinner on a private island. Multiple restaurant concepts, in-villa dining, elaborate breakfast programs, and beach picnics set up on sandbars are not just amenities. They're a primary profit center, frequently carrying margins north of 60% once volume is high enough. Spa and wellness is another major driver, and at destination resorts, it behaves differently than at a city hotel spa, which mostly serves guests already staying there. A destination wellness resort can pull in guests who book the property specifically for a multi-day wellness program, sometimes paying more for a week of treatments, fitness, and nutrition coaching than they pay for the room itself. Then there's the excursion and experience economy. Diving trips, private yacht charters, guided hikes, sunset cruises, cooking classes. These carry minimal marginal cost once the infrastructure, the boats, the guides, the gear exists, and margins on a well-packaged excursion program can rival food and beverage. Weddings and destination events function similarly to how they do in the hotel world, but at a different scale entirely. A destination wedding doesn't just book a ballroom for an evening, it books out 10, 20, sometimes the entire resort for 3 to 7 days, filling rooms during shoulder periods that would otherwise sit empty, while the couple pays a premium specifically for exclusivity. A single large destination wedding, with room blocks, catering, floral logistics flown in, and multiple event days, can generate 7 figures in revenue from one booking in resorts in shoulder season heavy markets. Increasingly build their entire commercial strategy around chasing this kind of business. Now for the part almost nobody accounts for when they dream about resort ownership. The physical toll the environment takes on the asset itself. A resort built on a beach, in a rainforest, or on a coral atoll is under constant assault from the exact natural beauty that makes it valuable. Salt air corrodes metal fixtures and HVAC systems at multiples of the rate seen inland. Humidity attacks with furniture, fabric, and structural elements. Storm exposure means insurance costs at coastal and island resorts run dramatically higher than comparable inland hotels, when insurers are willing to underwrite the property at all. Many overwater and beachfront resorts now report insurance costs consuming 4 to 8% of gross revenue, a figure that has risen sharply over the past decade as insurers reassess coastal climate risk. And in some hurricane-prone markets, resorts have had coverage pulled entirely and been forced onto expensive surplus lines policies just to keep operating. Because of that exposure, resorts run capital expenditure reserves far heavier than city hotels. A soft goods refresh, carpets, curtains, upholstery might happen every 5 to 7 years in a city hotel. In a beachfront resort, salt and UV exposure can force the same refresh every 3 to 4 years. Roofing, exterior paint, and pool infrastructure all wear faster in tropical and coastal conditions. Management agreements typically require an FF&E reserve of 3 to 5% of revenue set aside annually just to keep pace with this accelerated deterioration. And owners who skip or underfund that reserve in lean years often find themselves facing a brutal, all-at-once renovation built precisely when the resort can least afford it. Let's put real numbers around a resort and see what the business actually looks like. Imagine a 150-villa luxury resort on a tropical island. Development cost, $300 million, reflecting the imported materials, the utilities infrastructure, and the premium construction standard required to survive tropical weather. You've borrowed $200 million at 7.5%, putting annual debt service around $15 million. In a strong year, the resort runs 70% annual occupancy at an average daily rate of $1,400, driven by peak season pricing that can exceed $2,000 a night against a much softer shoulder season. That's roughly $54 million in rooms revenue. Food and beverage, spa, and experiences add another $38 million, reflecting how central those categories are to a resort's income statement. Total gross revenue, $92 million. From that, payroll, elevated by staff housing and the high service ratio, takes roughly $30 million. Utilities and infrastructure, running your own power and desalination, takes $6 million. Brand fees and distribution costs take $8 million. Insurance, given the coastal exposure, takes $5 million. General operating expenses add another $9 million. The FF&E reserve, funding the accelerated wear from salt air and humidity, takes $4 million. Operating income before debt service comes out to roughly $30 million. After the $15 million in annual interest, net cash flow lands around $15 million on a $300 million investment, a solid year by resort standards. Now we're in a soft year. A regional currency wobble keeps European travelers home. A named storm passes close enough to trigger cancellations for 6 weeks, even though it never makes landfall. Occupancy falls to 45%. Rate softens to $1,150. Gross revenue drops to roughly $58 million. Payroll barely moves because staff housing and core service levels can't be cut without damaging the brand standard guests are paying for. Insurance and infrastructure costs don't move at all. The resort limps to break even or posts an outright loss. While the $15 million debt payment comes due regardless of how many villas were occupied that quarter. That gap between the strong year and the soft year is wider, structurally, than almost anything in the city hotel business, because a resort has fewer levers to pull when demand disappears. It cannot rely on business travel to smooth out a bad leisure season. It cannot meaningfully shrink its workforce without unraveling the exact experience guests are paying thousands of dollars a night for. And it cannot simply wait out a bad storm season, because the storm season is often exactly when the resort needs peak revenue to offset a historically slow summer. So why does anyone still build these things? Because for the right owner, a resort was never really a bet on annual operating income in the first place. It's a bet on land that will never again be available at scale in that location, on a brand halo that lets a sovereign wealth fund or a family office put its name on something extraordinary, on tax mechanics, cost segregation, accelerated depreciation on villas and marine infrastructure, and eventual refinancing that can generate returns the income statement alone never shows. It's a decades-long hold on a piece of coastline that isn't being made anymore, wrapped in a business that, in any given year, might not make a dime. And behind every private plunge pool, every barefoot butler service, every sunset delivered on schedule to a guest who paid $2,000 for the night, that's the machine that's actually running, one that loses money as often as it makes it, and survives anyway because the land underneath, it was never really the losing bet.